Welcome to this video on navigating the downside, the mechanics, risks, and architecture of short selling. We'll explore the strategic balance and inherent risks of this complex trading strategy. Short selling is a strategy to profit from a security's decline. The short seller borrows shares from a lender, sells them for cash, and is obligated to return the shares later, hoping to buy them back for less. Short positioning reverses the baseline long position. It's driven by a bearish belief, involves borrowing, then selling, and has limited profit potential. Critically, it has unlimited maximum loss potential and strictly requires a margin account. A viable short sale requires specific conditions. These can include a broad bear market or high valuations at the macro level, and declining fundamentals or bearish technical indicators at the micro level. The life cycle of a short position begins with opening a margin account and identifying a target. It involves locating shares, placing an order, closing the position by buying back shares, and finally reviewing the outcome. Maintaining a short position involves several submerged costs. Beyond trading commissions, these include margin interest, hard-to-borrow fees for scarce shares, and the obligation to pay any declared dividends to the original lender. A successful short profits from the decline. In this example, 100 shares sold at $50 and bought back at $40 yields a gross profit of $10 per share, or $1,000 total. A failed short means paying a premium to cover. If the price rises, say from $50 to $65 per share, the short seller incurs a gross loss of $15 per share, or $1,500 total. The inherent asymmetry of short selling risk is vital to understand. Max profit is capped as a stock can only fall to zero, but losses are theoretically infinite, flipping the laws of market physics. Margin requirements act as a pressure valve. Traders use collateral to borrow shares. If the account equity falls below the 25% maintenance margin, a margin call is issued, potentially leading to forced liquidation. A short squeeze occurs when an unexpected catalyst spikes the price, triggering margin calls for leveraged short sellers. The resulting forced buying creates a massive demand shock, driving prices even higher and repeating the loop. The Volkswagen short squeeze in 2008 is a historical example. Investors shorted VW expecting a drop, but Porsche's secret acquisition led to a liquidity trap. This resulted in unprecedented panic buying, sending the stock price skyrocketing. Short selling offers advantages like profit generation during downturns, capital efficiency through margin, and portfolio defense as a hedge. However, it presents vulnerabilities like infinite loss exposure, a structural capital bleed from fees, and extreme tail risk from short squeezes. Key short selling metrics are the short interest ratio and the days to cover ratio. A high short interest indicates strong bearish sentiment. A high days to cover value warns of severe panic if a squeeze is triggered, due to the volume of shares needing to be covered. Regulations like the tick-up rule and mandatory locates provide guardrails. Despite its reputation, short selling is viewed by economists as a stabilizing force that exposes overvalued assets and enhances long-term market efficiency.